It is live. So I'm going to bring this down. Beautiful. Welcome to Coffee with Kristel. I do have another homemade cappuccino. I need to share the brand. This is a Maxwell. This is in the French. Um, I'm overseas right now. So happy Thursday. I'm going to attempt, but it's so hot. So how are you on this last few days of the month of August? And another coffee talk with Kristel, real talk, real solutions. And really what I encountered this week. So I'm going to start with something that happened last night. I'm reviewing this client's loan. And yes, I've got it on the live before I actually called the realtor and say, well, what did our client do? So Miss Elsa is buying a house, but she's been a co-signer for her daughter for several years. And we've agreed that we're going to provide 12 months bank statements to show her daughter is the one making the mortgage payment. So that way I don't have to count the debt against her. So let me just give you a little bit of explanation on debts that are paid by someone else. So when it's an installment or mortgage, or car payment, and we don't want to count the debt, so it's mother and daughter who purchased. So Elsa actually is not living in the house. So she bought with her daughter, she moved out, she has her own apartment, and the daughter's been making the mortgage payments. And we can show 12 months that she's been making the daughter the monthly payments and no late payments. If there's one late in the last 12 months, we have to count that debt against Elsa. But in this case, there's no late payment, and we just need to show daughter is making the mortgage payment from her account. Now, sometimes it's a joint account where it's husband and wife, let's say, and they're on the joint account. Well, that will not count because we can't differentiate who is truly on just that account. So we have to be able to show the person responsible who's been making the payments. There are some nuances for FHA. When you are a co-signer, let's say for a car, you have to show you actually co-signed for this debt. On a conventional, you are actually able to show if somebody else is making that payment, even if you're not a co-signer, because they've been responsible for it. So in that situation with Elsa, um, I'm going to ask her, why did she make a mortgage payment this month of August 1st? So it may be somebody else's debt, because she has her son that she may be helping. So that comes up, by the way, until you are closed, those mortgage statements have to be updated. Those proof that somebody else is making payments still have to be updated, not just until you're pre-approved, until you're closed. So whatever we agree on for your pre-approval, whatever we agree that as far as your debts, your income, number of hours you're working, you have to be consistent with that because we still verify your information until closing. So that's one thing that I wanted to share with you. Debt, but also keep up with whatever agreement you've made with your lender. This is what we're going to be doing. Don't change it. Don't decide just going to help somebody out because it can actually impact you. But I'm sure we're going to have a solution for Elsa. Another one that I want to share with you. So take a sip in between because I know I talk fast. So this is like almost a practice for me to have a coffee to take breaks. You currently own a house and you want to buy another one. And you have enough equity in the house where you want to take the equity in that house and buy the other one without necessarily having the house on the market or the house sold first. So in this scenario, let me just go specific in this scenario. Miss Carol has a house in Georgia that is on the market, and she is going to be um, selling it, and she needs the money from the equity to purchase her property in Florida. Well, that house in Georgia hasn't sold yet. So we are doing what's called a bridge loan. So I do have a couple of options for her. One of them is doing, I want to make sure I'm going to share the correct screen. Yeah, that one. So one of them is going to be a HELOC where even though the house is listed, I can still do a line of credit. And take the money and she'll have to qualify now, right? So if in her case, she's not the one buying the new house in Florida, she's gifting the money and she's removing the house. But if she were to buy the house in Florida herself and qualify, we have to remember that that line of credit, that debt is going to be counted as a debt to income ratio. So you have the house in Georgia, there's a mortgage payment on it, we're getting a line of credit. So there's that debt plus now the new debt and the house in Florida. So she would have had to qualify for all of those debts to be able to still buy in Florida without selling the current house. But there is a solution for those who either we have to remove the mortgage from their credit because they will not qualify. So it's a bridge loan. There are other options that we call short-term, basically selling it, a transaction that we're taking with some specific lenders. But coming back to Miss Carol, she just needs the money and the house hasn't sold. So I'm going to share my screen. Okay. So it's bringing up. So in this scenario, her house is worth over $600,000. And they're taking a guaranteed backup contract of 460. So they do an amount that we're using to find out how much we give as a bridge loan. So although the house is worth over 600,000, she's going to continue trying to selling it, trying to have it on the market. It's still active on the market. There is a guaranteed backup contract that's costing about 2,500 in this scenario. They take about 90% of the guaranteed backup contract. So that's $421,000. From that, there is a mortgage of 316. And then what's left is 104,000. From the 104, there are some fees because we're doing a loan. She doesn't have a mortgage payment, so no monthly payments due. Interest will accrue and is due at the time of payoff. So this is not necessarily like cheapest and go forward and there's no cost. There are some costs associated. The lender is actually giving you a loan contingent on you selling the house, but still giving you a guaranteed backup contract offer. And there are two steps for this, but in this scenario, because we only need the money to gift to her son to buy, we're only doing the buy sale transaction. There is an option to actually get that home off of her credit. All is legal, right? So it's not like hey, paying for something to be paid off. It's like a loan that's being done to get it off and a guaranteed debt. So a guaranteed contract. So again, $2,500 cost, some fees associated according to the amount. So Miss Carol is getting $104,000. She actually only needs 70,000, but the 2,500 is money that she needs to pay upfront when she gets the bridge loan, and then the rest is deducted from the line that she will be getting. Interest rates, as we saw on here, listed will vary, but for right now, this is the interest rate that they are basically showing with some origination fees. Okay, so there are options if you have a house that's listed, because we know homes are staying on the market a little bit longer right now, but you still want to move forward with your transaction, or you thought, you know what, or you're a realtor and you thought your client's house was going to sell, it hasn't sold, and you need to find a solution so they don't lose their earnest money or even the house that they are under contract, even though they may have a contingency to sell the house. So bridge loans are options, line of credit, bridge loans, and other options that I have to provide a solution on scenarios like Miss Carol. Okay. Sip again. It's very hot, so that's why you're not going to see going down very fast. Can't say the Maxwell one is not the best flavor. I like the other one. I'll have to show you the brands. So the other scenario, down payment assistance. There are so many ways to structure down payment assistance. There are some banks who have their special programs. I have a grant. But all of those programs, very often, they need a 660 credit score, 680, like higher credit scores to do down payment assistance. I do have a program that's a 640 credit score option, and I actually did not pull up the clients. The loan estimate is or the worksheet is very complex because I'm getting him an estimate for a $400,000 home that he needs only 4,000 to purchase. So it's actually going to make more sense if I share with you the numbers. So bear with me as I bring this up. Let's look at this one. Should we do the 330 or the 400? Let's do the 400 because it seems almost like, what? They only need 5,400? Okay. Just trying to make sure I'm keeping all information private as far as names and everything while making the screen legible. Okay, so let me go ahead and share my screen. A way that I structured a down payment assistance option, it is a first and a second mortgage. There are some that are non-repayable, but the interest rates are higher, and the cost of getting those loans require the client to actually have more money available. We can do 3.5%, we can do 5% options as far as FHA is 96.5. We can do 3.5, so that becomes 100% financing. But we can go over the 100% financing. And let me come back to this scenario of going to the max of the value because people say, oh, you can refinance. That's true. But let's talk about that in one moment. So let's take this scenario, $400,000 purchase. The down payment is $14,000. And I'm going to jump here. So, can I use this notes? Yeah. So we have the price here. Down payment, 14,000. Okay. Now, you can see subordinate financing, which is really here, the 14,000. So I'm giving him a credit here for the 14,000. So we're doing it a 3.5% down option. Okay. And I'm not going to go over the fees. Those are normal fees, underwriting fee. There are other processing fees, all those change depending on the program that I use. So we're not really focusing on this. We're focusing on actually you can see this is somebody I priced it with a 640 credit score, and rates are still pretty competitive. The second is going to be 2 points higher than this right here. Okay. Again, this is just an example. We do have APR listed here. This is just a scenario so you can see that there are options when it comes to down payment assistance. Oh, and the reason why we're going with the first and the second, and it's not the one that's forgivable, it's with the repayment, is because they make over $145,000. So they are over a lot of down payment assistance programs and the credit score, as well as the biggest impact is the income. Okay. So of course, as I move this, I actually haven't learned how to remove all those circles that I did. The beauty of going live. Anyways, now let's go ahead and take this again. So there is a first mortgage with the interest rate that I shared. We have a second here of 148 is for 15 years. So a total monthly payment of 3,800, and the client needs about 5,400. Now, how did I come up with this? So the sales price, 400,000. Prepaids, closing costs, mortgage insurance is financed in. We're getting $14,000 down payment assistance, and then we have a seller concession of 10,000. So this particular case, the client will need to have the seller concession. Otherwise, they would need 15,000, which still it's amazing because down payment is 14,000 plus closing costs plus your escrow, which is taxes and insurance. Technically, you will need almost $30,000, right? So in this scenario, he's getting an estimate. So I'm telling him to achieve the goal with you having only $5,000, of course, save, right? Save in the process because you don't know if the seller is going to pay you 10,000. You don't know if they're going to pay for your agent's commission. This is really tight in this market. But with properties being on the market for a while, who knows? He might actually find the right property. This is a pre-qualification right now. So that's why we're not under contract, but I'm explaining numbers to him on this basically $400,000 purchase, down payment assistance, which is a repayable loan, $3,800 monthly payment estimate, as you can see on the first and the second, making over 145,000. Not too many debts that they have. So just wanted to share with you down payment assistance, basically 100% financing. There are other programs that are more attractive as far as the terms, but the restrictions are also there. Like I mentioned, they are over the income limit. So don't jump on me and say, well, I'm getting a better deal. You probably are. There are some other programs like Georgia Dream that may have lower interest rates, but the income limit is a factor. The fees that they charge to get maybe about 10,000 a quote based on their actual loan amount. So there are nuances for each one of those down payment assistance programs. Okay. Let's see. Next topic. Refinance rate and term. So a lot of my clients already have very low interest rates. Very few have rates that are over 6.5, where it makes sense to even have a conversation to refinance, unless they have a HELOC and now they're ready to blend, or they want to refinance and take some cash out. Right now, it still makes sense for a lot of people to use a HELOC, a line of credit, in 5 minutes. I tell you, literally 5 minutes. Like, I get all your information in 5 minutes. I give you answers of what you can do. And then we go through the approval process. And in 5 days, you can actually sign and then fund. So you can the first step very often for me is let's talk about the HELOC. How much equity do you have? Because when you're doing a refinance cash out, most programs are going to be up to 80% of the value of the home. A HELOC, a line of credit, which is different than a HE loan, but I do have one that's amazing. It's like a fixed interest rate, and you can draw back on it for 5 years. But I'm going to go ahead and compare terms, time frame to wait. So on a HELOC, usually you have to wait about 90 days of having owned the property before you can access the equity. Most of the times, each HELOC have their nuances and their fine prints, their underwriting guidelines. On a refinance rate and term, so you're an FHA or conventional and you want to refinance for somebody who got a rate that maybe like they do the down payment assistance and they have a 7.75% interest rate. And then you can refinance right away. There is no prepayment penalty. There is no time frame to wait. But the numbers have to make sense. So this is what I was going to come back to. When you're doing 100% financing, meaning you have a $14,000 lien on the example I shared with a 400,000, 3.5%, we did 100% financing. When you're ready now to refinance a year later, 6 months later, the numbers will not make sense. You haven't reduced the principal balance on this loan and you have a second lien on it that we have to basically increase now the first loan to include that lien. So although there is no prepayment penalty, and it really touches my heart because I do tell those clients about this, but some loan officers don't. And what happens is that when they reach out to me, I explain to them, yes, you can refinance. That's true. Period. You start a new paragraph. But does it make sense? Will you be able to based on the type of loan that you got? So when a client comes to me and they do a no income verification loan, and then I tell them, yes, you can refinance. There's no time frame you can do it. But I have to ask you, what is going to change in 6 months, in a year, that now I can actually give you more income to qualify you for that same loan or a loan that you're going to refinance into? If nothing is going to change, you're going to be, quote unquote, stuck with that loan until something changes for you. Or rates have decreased tremendously, even for the same type of program. And programs where we don't verify income, or we do bank statements, or we do alternative income, they're not the lowest interest rate. The less information you provide, of course, the risk is higher. So that means the interest rate is higher, or you put more money down. Okay. So coming back to the rate and term. So when you're doing a rate and term, meaning you're just refinancing the balance, and we might finance some closing costs, some programs. We're not taking money out to give to you, okay, to pay off debts or do improvements. That's called a rate and term. So for this program, you can technically refinance at any time. You can go higher than 80%. Very often, you can go up to 95, 97%, and FHA, you can go higher. So that's your rate and term. You're not getting money out. You're just refinancing the current term. And there has to be a benefit to you where you're actually saving, or you're going from an adjustable rate to a fixed rate, or a shorter term. Okay. So 30 to a 15-year. Now, when you're doing a refinance cash out, meaning you want to draw money from the equity of your home, 80% is usually the maximum of the loan to value, meaning the value of your home, multiply that by 80% minus what you currently owe is how much you could potentially access minus your closing costs. Very often you have to wait about 6 months and a year to have been on title of this property to be able to do that. I've had some investors come to me and say, well, it's in a partnership that I did and I want to refinance and take some money out, but I wasn't a partnership. No, I'm sorry. The way that this scenario worked is that they were in a partnership, meaning they bought it together, but not on paper. So they have a LLC in one person's name. Now, the other person, the partners that's silent, did not get on the title and they want to refinance and take the money out as well. Well, we need to wait for you to be on title for a period of time, usually 6 months to a year, depending on the investor. So you got to think about those scenarios when you are, well, don't think about it, call me and I'll help you, of course. But keep that in mind that depending on the type of refinance we do, you may have to be on what's called a seasoning of being on title. So period of time of being on the mortgage. All right. HELOC. I do want to talk about HELOC again because I think it's a hot program right now because one of the programs that I have on the HELOC, you can pay off debts to qualify. You can pay off debts to consolidate debts as well, even if you don't need to qualify. So a lot of times, credit unions or banks require you to qualify with your current debt and the line of credit you're going to be getting. And that sometimes stops you because very often you want to blend or consolidate, is a better term, your debts to improve your cash flow. So I can definitely help you, and I've helped several clients where they are consolidating their debts, or sometimes they actually accessing the equity. So I have Miss Glenda, who she actually reached out to me to use the line of credit to finance her car, and I said, go ahead and check. What is the interest rate they're going to give you based on the car you're buying? Sometimes you might get a better term instead of using that debt and you have good credit. Go for it. Check what the terms are with your car dealership or even better at your credit union for an auto loan versus using that money to in equity to get a car. So she did that, but now she came back and now she's ready to, and she's actually under contract to close next month. Her and her brother found a property that is somebody inherited and they're ready to get rid of it. They don't want to spend the money to fix it. They actually don't have the money to potentially to fix it and put it back on the market. So they found a great deal, a house that's worth over 300,000 that they're getting, they have over $100,000 in the equity to be able to flip this property. So it's a fix and flip that they're doing. So yes, I do have access now to fix and flip options. But Glenda used a line of credit on her house to have money available to do this fix and flip. I'm going to add some nuances to her scenario because it's a very special one. She's a not first time buyer, but a first time investor. So this is the first time she's going to do a fix and flip. Whenever you're first time fix and flip, your terms are not necessarily the most sexy or attractive because you don't have the experience. If you do a fix and flip, that means very often you're going to have repairs you're going to do. So that means contractor. That means you need to have a GC, a general contractor, and someone who is going to work with you to ensure your timeline is not too long. Because as you're waiting for this property to be fixed, you're making payments at least on the money of the finance of the purchase. Maybe not so much on the disbursements for the fixing of the property, but there's still money being paid because you're holding this home. You can't rent it. You're getting it ready. So you had to have money saved and available to get this property ready. So with Glenda's situation, she needed a little bit more money than, let's say, a 20%. Sometimes we can do higher financing than a 80%, so less than 20% down. But because she's the first time, the terms are tighter. So her brother is also gifting her money. So some programs of investors don't always allow gifting money. So seasoning of money is very often a question, but we do have an investor who's going to go ahead and give her the funds. So there are solutions out there. That's the beauty of me having made this switch to Nexa, because with Nexa, I have an array of options And depending on the nuances of the client situation, first-time buyer or first-time investor on a fix and flip, those different investors have different appetite for those programs. So if you have an interest in doing a fix and flip, or you just want to buy more investment properties or your next property, let's look into your line of credit, accessing the equity. And if you have no balance on your line of credit, you basically will not be making a payment. You have 5 years to basically have your own bank where you take the money, you keep it in your bank, or you pay it back and you can draw back on it for 5 years, and you can do fix and flip. You can buy another property that you are interested in buying, like a second home or vacation home or any other projects. All right, let's see what else I wanted to talk about. Yes. So I have a contract for a property in Atlanta. The buyer as well as the home inspector noticed that there is the floor is not very even. So on the contract that I received, the structure of the floor is mentioned. So underwriting, of course, anytime you have structure, you have mold, you have some keywords, even though it's a conventional loan, this does require for us to ensure the structure of the property is sound. Now, it wasn't a structure of the property, it was more the floor wasn't even the way that they fixed it. So they have a professional on the contract who is going to go ahead and, according to contract, it says a professional in the field is taking care of this flooring. Good news, the appraiser hasn't gone to the property yet. So we're making sure that all those repairs are being done first. So when the appraiser goes, he can do one swoop and just double check the floor is fine. Otherwise, she will need to do a final inspection to ensure the repairs are done. So whenever there's structural mention on a contract, it is a red flag for us. We have to make sure that the floor or anything structural is handled. Now, it depends on what the appraiser is going to come back and say. If he says there's a structural issue with the foundation, that's a whole different ballgame. But I'm going to trust and hope this is really just a floor according to the inspector anyway and the buyer. So things to think about, keep in mind. Home inspection is very important because it helps you in negotiating as well. In her case, where they are fixing it, sometimes you can say, in this case, they would have an issue because it would not have been able to close. So it's you can renegotiate when you do a home inspection. So do not skip that step. Doing your due diligence to get a home inspection, you can renegotiate for closing costs to be paid, or you can go ahead and negotiate for repairs to be taken care of specifically by a contractor. You want to go ahead and licensed contractor. You want to make sure, even as a buyer, that you double check you feel comfortable with the work done. I actually had a client, Mr. Jesus, who purchased a home and the repairs were done, but they were in sloppy job. He said, I'm not closing it until this is done by a professional and I like the work. So you want to be willing to walk away from a deal just to make sure you ensure you're not signing on something and regret and say, I wish I had said something. Once you sign, you're done. So sometimes you have to detach yourself from the situation and really do what makes sense and not just be, oh, I just love the house and who cares? Because down the road it's going to cost you. So all those are key points. So today we talked about your debts. If you're a co-signer or if you have a debt being paid by somebody else, until you close, just make sure you continue the way you've been doing it. Don't change things. It also helps in qualifying when a debt is not counted, and we can show 12 months to somebody else is making payment from their own account. We talked about bridge loan, down payment assistance, refinancing, rate and term, cash out, HELOCs, and time frame of the waiting before you can do that, and the loan to value. So all of those are things that I'll go over with you. Some people don't want to go in too much detail, but I still like a little bit of education so you understand why I say what we can or cannot do. And then also HELOC for fix and flip and structural floor. So I will love your questions, and so I can address them. And I will continue to share what's coming through my desk, through my realm, and provide solutions. So you can tell I didn't really care for this coffee as much. This brand is not necessarily my favorite. But this is Coffee with Kristel. We'll talk real solutions. I'm here for you. Feel free to use my calendar to book a call. If you're a realtor, any strategies that you would like for me to chat with you about, as well as collaborations. I love collaborations. It's one thing to talk to myself on the screen where you can get this information. It's another way I get to collaborate and bring a professional or a business person. If you are not even a realtor, but you're in this space and you're an investor, for instance, we'd love to connect with you. Um, Cheers. Let me try this coffee again. Not the best. You can tell this is homemade compared to my other one. I have to share it. All right. Thank you.